How to analyze the stock of a company. In our last video, we saw what a stock was and how we can use it to make money. If you've not seen this video, I invite you to do so because it is important to know what a stock is before trying to analyze it. Just click on this and it will automatically take you to the video. Then you can come back and watch this one. Okay, so in Wall Street, you have to know that there are two main techniques to analyze a stock. We are talking about fundamental analysis and technical analysis. Which one is better? Well, this has been debated a lot over the years, but it's not the right question to ask. We should do so with which one is more attached to your investment style. In this video, we're going to try to answer this, but to do so, we have to understand what each one is about. Let's start with fundamental analysis. This basically seeks to find the intrinsic value of an asset. In the case of the stock market, the asset would be the stock. The intrinsic value would be the price at which the stock is supposed to be trading on the stock market. For example, a share may cost $100 in the market, but according to the intrinsic value, this share should actually be at $50. Why does this happen? Well, remember that the price of the share is determined by the supply and demand of the market, and this price may have reached such a high point that it would be insane to buy it. Remember, the demand will not always make a lot of sense. During the COVID crisis, for example, Hertz declared bankruptcy, and right after this announcement, the stock practically doubled. Do you think that makes sense? Obviously not. But let's take this as an example to explain the fundamental analysis in a simpler way. Let's say that Bob loves hamburgers, and one day he sees that a restaurant is selling a truffle burger for $500. Yes, it is very expensive. But since Bob loves hamburgers and truffles, he will not hesitate and will buy one. After this, he will invite his friends will invite theirs, and so on. The restaurant owner now realizes that people love his hamburger, so he will start to raise the price because he wants to make more money. The price will go up to $550, $680, $700, all the way to $1,000. Now, let's imagine that Robert, the Wall Street investor, surprised to see this growth in the sales, decides to invest his money with the chef in exchange for 20% of the sales. The chef and Robert agree and make the deal. Robert gives him $100,000 and the chef gives him 20% of his sales. If Robert wants to recover his investment, a minimum of 500 hamburgers should be sold, since for each hamburger he earns $200. The problem is that Bob, when he sees this new price, is no longer going to buy hamburgers because it makes him insane to buy a hamburger at that price, knowing that on average it would cost him $200 to buy a hamburger in a restaurant. Therefore, he will no longer invite his friends. People are going to start to realize that the burgers are really expensive and will gradually stop going. As no one will be willing to buy the hamburgers anymore, the chef is forced to lower the price of the burgers to 700, 680 until it reaches 500. Seeing that the price is low, people will start to be interested in the hamburgers again, and everything is fixed. Well, it might seem that way, but not really. Because now, Robert, the great investor, is not going to need the chef to sell 500 hamburgers to recover his investment. But now he's going to need to sell twice as much, so 1,000 hamburgers, since the price for a hamburger, now down to 500, only earns him $10. If Robert had done fundamental analysis, he would have seen that the intrinsic value of the hamburgers was 550 and would wait for the price of the burgers to be closer to that price. Well, this is exactly the same with stocks. You find an intrinsic value and wait for the set market value, which is the current share price, to reach the intrinsic value at a minimum, and preferably below it. If not, you will lose your money like Robert, who made his deal at a time when burgers were too expensive. How can fundamental analysis come up with an intrinsic value, though? Well, to come up with this intrinsic value, the investor will have to study many metrics. He will have to analyze various macro and microeconomic aspects, such as the economy of the country where the company is from, the sector to which the company belongs, and so on. In a more micro way, he will have to study the numbers of the company, sales, profits, cash, debt, and so on. Then decide how expensive it is by looking at those numbers. To see how expensive the stock is, he will use several multiples, such as the P/E ratio, or price to earnings ratio, the PS ratio, or price to sales ratio, the PB ratio, or price to book ratio, etc. To calculate the intrinsic value, you will have many options of formulas. There is the valuation by multiples, the DCF for its acronym discount of cash flow, the DDM for its acronym discount of dividend method, and so on. For each of these topics, we will have a video on the channel. So, if you watch this video sometime after it's released, I would recommend you to go to the channel and you will surely find a video for each topic. Now, technical analysis. What is this about? Well, unlike fundamental analysis, which attempts to evaluate the value of an asset based on business results, such as sales and earnings, technical analysis focuses on studying price and volume. What does this mean? Well, let's go back to the hamburger example. As we saw, the price of these was fluctuating over time due to supply and demand. If we graph this price fluctuation, we will obtain this graph. In real life, a stock chart would look more or less like this, but let's not get complicated. What the technical analyst is going to do is look for patterns, supports, resistances, and use different indicators to make a decision to buy or sell the asset. Basically, the only thing that a technical analyst is going to rely on is the movement of the price and the volume to make his decision to buy or sell the asset. I think you already know what price is, but what is volume? Well, it is simply the number of sales and purchases of the asset. If this is a well-known asset, the volume is likely to be very high, and if it's not known, the volume will be low. In price fluctuations, you can identify patterns such as double top, head and shoulders. No, not the shampoo. The rising wedge, double bottom, and so on. For what concerns the supports and resistances, these are levels at which prices are going to rebound, either in an upward or downward trend. And as per the indicators, among the best known we have the MACD, the RSI, the DMI, the parabolic SAR, and so on. Like for the fundamental topics, we will have a video on the channel for each one of these. In technical analysis, there is a phrase that you will surely hear if you decide to take this path. The trend is your friend. Basically, this phrase describes in great aspects what technical analysis is. You must follow the trend, whether it is bullish or bearish of the stock. So in summary, we can say that what fundamental analysis does is analyze various economic aspects in order to arrive at an intrinsic value. Technical analysis will simply analyze the movement in asset prices to make a purchase or sale decision. Alright, at this point, each person can make their decision. Let me know in the comments which one you prefer, fundamental or technical. Thanks for watching the video, and if you liked it, share it, give it a like, and subscribe.